Right now, as you're watching this video, there's a $2.1 trillion time bomb buried deep in corporate America's balance sheets, and the timer just accelerated. In the next 18 months, this debt comes due. Most of it was borrowed when money was free. Interest rates at 1%, 2%, sometimes even 0%. Today, companies have to refinance at 8%, 9%, even 10% interest rates. The math is brutal, and it's about to expose which companies in your portfolio are actually walking dead. Before we reveal which Fortune 500 companies are most at risk, make sure you're subscribed to Capital Collapse, because what I'm about to show you isn't being reported on CNBC, Bloomberg, or any mainstream financial media. Here's what makes this different from previous debt crises. We're not talking about subprime mortgages or over-leveraged consumers. This is corporate America. The companies in the S&P 500, the stocks in your 401k, the safe blue-chip investments your financial advisor told you to buy and hold, and the warning signs are everywhere, if you know where to look. Let me paint you a picture of what happened between 2020 and 2023. The Federal Reserve dropped interest rates to zero. Corporate treasurers saw an opportunity. They could borrow money for essentially free and use it to buy back their own stock, pay dividends to shareholders, make acquisitions, and refinance old debt at lower rates. It was financial engineering at its finest, and everyone was doing it. In 2020, corporate debt issuance hit $2.3 trillion in a single year. 2021 saw another $1.8 trillion issued. 2022 brought $1.5 trillion more before rates started rising. Total corporate debt outstanding now stands at $10.5 trillion. But here's the problem. Most of this debt was issued with 3 to 5 year maturities, which means it's all coming due right now, in 2026 and 2027. And the companies that borrowed at 2% have to refinance at 8%. Let me show you what that actually means. Let's take a real example. I'm not going to name the company yet. We'll get to specific names in a minute. But this is an actual S&P 500 company. The company has $15 billion in total debt. The interest rate on their existing debt is 2.5% issued back in 2021. That means they're paying $375 million per year in interest expenses. Their operating profit is $2 billion, giving them an interest coverage ratio of 5.3 times. That's comfortable. Now that debt matures in 2026. They need to refinance. After refinancing at 8%, they still have the same $15 billion in debt, but now at an 8% interest rate. Their new annual interest expense jumps to $1.2 billion. Operating profit stays at $2 billion. Their new interest coverage ratio drops to 1.67 times. That's the danger zone. That's an extra $825 million in interest payments every single year. Money that was going to shareholders, employees, innovation, growth now goes to bondholders. And this company is one of the good ones. They actually have $2 billion in operating profit. Now let's talk about the zombie companies. According to Bloomberg Intelligence Analysis, over 600 publicly traded companies in the United States are now classified as zombies, companies whose profits don't even cover their interest payments. These companies only exist because they could roll over their debt at low rates. At 8% interest rates, they're mathematically insolvent. Now let me show you which sectors are sitting on the most dangerous debt loads. Total commercial real estate debt maturing between 2026 and 2027 is $550 billion. The average interest rate on existing debt is 3.2%. Current refinancing rates are running between 7.5% and 8.5%. And here's the killer. Property values have fallen 30 to 40% since 2021. Here's the math. A $100 million office building financed at 3% was paying $3 million per year in interest. At 8%, that's $8 million per year, an extra $5 million that has to come from somewhere. But rental income hasn't increased. It's actually decreased because of work from home. Office vacancy rates in major cities tell the story. San Francisco is at 35.7%, New York at 18.3%, Austin at 24.1%, Chicago at 22.8%. The companies at highest risk include SL Green Realty, a Manhattan office REIT with a debt-to-equity ratio of 1.8 times, Vornado Realty Trust at 2.1 times, Boston Properties at 1.6 times, These aren't recommendations to short, but if you own these in a REIT fund, you need to know what you're holding. Total retail sector debt maturing is $380 billion. There are 87 publicly traded zombie companies in retail. The average interest coverage ratio across the sector is just 1.2 times, borderline survival territory. Why are they vulnerable? The American consumer is tapped out, credit card debt at all-time highs, savings rate at decade lows, student loan payments have restarted. Discretionary spending, the stuff you don't need, gets cut first. I'm going to name names because this is public information from their 10K filings. Macy's has $4.7 billion in debt with $650 million maturing in 2026. Their interest coverage ratio is 2.1 times. Nordstrom carries $2.9 billion in debt with $500 million maturing in 2026. Interest coverage ratio of 1.8 times. Kohl's has $2.1 billion in debt and same-store sales declining for 3 consecutive quarters. These companies aren't going bankrupt tomorrow, but their stock prices are going to get crushed when they have to refinance at higher rates, destroying profitability, or issue new stock to raise capital, diluting shareholders, or sell assets at fire sale prices. This one surprises people. Total energy sector debt is $420 billion. 42% of shale oil companies carry junk-rated debt. The break-even oil price for many of them is $65 per barrel. When oil was at $90 to $100 per barrel in 2022, these companies looked fine. Today, oil's at $72 and falling. Watch the small-cap shale producers with debt-to-equity ratios over 2.0. Any energy company with negative free cash flow, exploration companies that borrowed heavily to drill during the high-price environment. If oil drops to $60, which it did in 2020, a third of these companies face severe financial distress. Yes, even tech is at risk. Tech sector corporate debt totals $890 billion. 38% of Russell 2000 tech stocks are unprofitable. 67% of SaaS companies have negative EBITDA. Now, not all tech is created equal. The Magnificent Seven, Apple, Microsoft, and the rest have fortress balance sheets. They're fine. But the mid-cap and small-cap tech companies that grew during the zero-rate environment, many have never been profitable. They borrowed heavily to finance growth. Revenue growth is now stalling, and their burn rate exceeds their revenue. Let me give you a real example from an unnamed SaaS company. They have $500 million in debt at 4% that matures in 2026. Annual revenue of $200 million. They're operating at a $50 million loss per year. Cash burn is $75 million annually. When they refinance at 10%, that adds another $30 million in annual interest expense. This company doesn't make it to 2028 without an emergency capital raise that dilutes shareholders by 90%, an acquisition at a distressed price, or bankruptcy restructuring. Now let me explain the specific events that will trigger this debt crisis. These aren't predictions. They're on the calendar. $287 billion in corporate bonds mature between January and March 2026. That's the largest quarterly maturity in history. Companies must refinance or default. When this many companies hit the refinancing market at once, 2 things occur. First, supply overwhelms demand. There aren't enough bond buyers for all this new issuance. Second, rates spike even higher. Companies have to offer more yield to attract buyers. This creates a doom loop. High rates mean companies can't afford to refinance. Credit ratings get downgraded. Even higher rates are then required. We saw this playbook in 2008 with different assets. The pattern is the same. This is the psychological trigger. Right now, investors assume the Fed will step in and save everyone. They assume companies will figure it out. But when the first major company, a recognizable name, a company in the S&P 500, actually defaults or files bankruptcy, the contagion begins. Credit default swap spreads blow out. Bond funds face redemptions. The rush to the exit starts. Based on current metrics, candidates for the first domino include any regional bank with over 40% commercial real estate exposure, unprofitable EV manufacturers burning over $1 billion per year, and retail chains with declining same-store sales combined with high debt loads. I'm not predicting which one. I'm saying the probability is high that we see a major default in Q1 or Q2 2026. Here's the mechanism. When Moody's or S&P downgrades a company from investment grade, that's BBB, to junk status, that's BB, several things happen immediately. Many institutional investors must sell. Pension funds and insurance companies can't hold junk bonds. This forced selling drops the bond price. A lower bond price equals a higher yield required. The company now faces even worse refinancing terms. The data shows 89 companies are currently rated BBB-. That's one notch above junk. Total debt of these fallen angel candidates is $478 billion. If even half get downgraded, that's $239 billion of forced selling hitting the market. This is a powder keg. I want to teach you how to identify these zombie companies before they collapse so you can protect your portfolio. Here are the 5 red flags. The formula is operating income divided by interest expense. This tells you how many times the company can pay its interest from profits. Above 3.0 is safe. Between 2.0 and 3.0, you should monitor closely. Below 2.0 is danger territory. Below 1.0 means they're a zombie. Their profit doesn't even cover the interest. You can find this in the company's 10Q or 10K filing on the income statement. The formula is total debt divided by shareholder equity. This shows how leveraged the company is. Below 1.0 is conservative. Between 1.0 and 2.0 is moderate. Above 2.0 is aggressive. Above 3.0 is the danger zone. One caveat. Some industries like REITs and utilities naturally have higher ratios. Compared to the sector average, the formula is operating cash flow minus capital expenditures. This tells you if the company is generating or burning cash. This matters because companies with negative free cash flow must borrow to survive. When rates are high and credit markets tighten, they die. You find this on the cash flow statement in quarterly reports. Look for situations where more than 30% of total debt matures in the next 2 years. This means refinancing risk is concentrated. You find this in the footnotes of the 10K under the long-term debt section. It shows the maturity schedule. Here's an example. A company with $10 billion in total debt. If $7 billion matures in 2026 and 2027, that's danger. If only $2 billion matures in that time frame, that's manageable. This measures the insurance cost against company default. You can check this on Bloomberg Terminal if you have access, or free sites like Fred Economic Data. A CDS spread under 100 basis points means the market sees low risk. Between 100 and 300 basis points indicates elevated risk. Over 300 basis points means the market is pricing in real default probability. Here's the actionable tool I want you to use. Go to your brokerage account holdings. For each stock, pull up the latest 10K from sec.gov. Check these 5 metrics. If 3 or more red flags show up, seriously consider selling. This takes 5 minutes per stock and could save you from a 50 to 80% loss. So what are institutional investors doing right now to prepare for this? Quality in this context means companies with low or zero debt, ideally a net cash position, consistent free cash flow generation, investment-grade credit ratings, and recession-resistant business models. Actual examples of quality include Microsoft with a net cash position and 808 credit rating, Costco with a debt-to-equity ratio of 0.5 times and a fortress balance sheet, Visa and MasterCard with capital-light business models and minimal debt, Berkshire Hathaway sitting on a $380 billion cash pile. These aren't the most exciting stocks. They won't multiply your money by 10 times, but they won't go to zero either. This is what vulture funds like Oaktree and Apollo are doing. They're waiting for defaults, buying bonds at 30 to 50 cents on the dollar, taking control in bankruptcy proceedings, restructuring the company and reselling it. Regular investors can access this strategy through distressed debt ETFs, high-yield bond funds, though you need to be selective, and specialty closed-end funds. Warning, this is high risk. Only allocate 5 to 10% of your portfolio maximum. If you own index funds, you're automatically exposed to these debt bombs. Here's the defensive rotation. Reduce exposure to retail, commercial REITs, and unprofitable tech. Add healthcare, utilities, and consumer staples. Increase your cash position. 5% Treasury bills yielding 4.5% is actually pretty good. This isn't about timing the exact crash. It's about not being overexposed when it happens. Here's your step-by-step action plan to implement this week. Make a spreadsheet with every stock you own, the sector it's in, its debt-to-equity ratio, its interest coverage ratio, and what percentage of your portfolio it represents. Highlight anything with 3 or more red flags in red. Add up the percentage of your portfolio in high-debt sectors like retail, commercial real estate, and unprofitable tech. Then add individual companies with debt-to-equity ratios over 2.0. If this totals more than 30% of your portfolio, you're overexposed. Don't sell everything tomorrow. That's emotional. Use the systematic approach. Week 1, sell your highest risk position, the one with the worst metrics. Week 2, trim your second highest risk position by 50%. Week 3, reduce sector concentration. Week 4, rebalance into quality and cash. This gives you time to be strategic about entry and exit points. This debt crisis will create amazing buying opportunities when quality companies get sold off in the panic. My watch list includes companies with net cash positions trading at 10-year low valuations. Dividend aristocrats. That's companies with 25-plus years of dividend growth if they drop 20% or more. And recession-proof businesses experiencing temporary sell-offs. Set price alerts. When panic hits, you're ready to buy, not sell. Here are the targets. Conservative investors should hold 20 to 30% cash. Moderate investors, 10 to 20% cash. Aggressive investors, at minimum 5 to 10% cash. Where should you hold it? Treasury bills yielding 4.5%, backed by the U.S. government. High-yield savings accounts paying 5% or more at some online banks. Money market funds. Cash is not trash when interest rates are 4 to 5%. Volatility is coming and opportunities will emerge. Mark these dates. February 15th, 2026. That's a major maturity date for corporate bonds. April 30th, 2026. Q1 earnings season. Watch for guidance cuts. July 2026. The midpoint of the maturity wall. October 2026. Q3 earnings. The recession will likely be showing in the numbers by then. On these dates, review your portfolio and check if your thesis is playing out. The $2.1 trillion corporate debt bomb isn't a conspiracy theory. It's not doom-mongering. It's mathematics. When you borrow at 2% and have to refinance at 8%, something breaks. For some companies, it's their profit margins. For others, it's their stock price. For the zombies, it's their existence. Here are the 3 things I want you to remember. This isn't about predicting the exact date of collapse. It's about recognizing that risk is elevated right now. Position accordingly. Not every company with debt is doomed. Many will successfully refinance, cut costs, and survive. But you need to identify which ones. This crisis creates opportunity. Every market dislocation transfers wealth from the unprepared to the prepared. Make sure you're in the second group. I've given you the tools, the 5 red flags to identify zombies, the sectors most at risk, the specific action plan, the key dates to watch. Now it's on you to actually do it. Don't wait for CNBC to tell you it's time to worry. By then it's too late. If you found this analysis valuable, subscribe to Capital Collapse, share this with someone who needs to see it, and hit that notification bell. I'll be tracking this debt situation monthly with updates. Remember, the goal isn't to predict the future. The goal is to survive it. Thanks for watching.